Hi guys, welcome back. Still here at the early trading course with Swavely Markets as we move to module 2, fundamentals of the Forex markets. Okay, so let's get started with the asset range traded in FX. We did mention a bit of that in the previous model where we spoke about, the different types of assets that could be traded. And assets are simply like products that, we buy and sell in order to be able to, hopefully make profit. And we will be looking at some of those assets in a little bit more detail right now. So we mentioned earlier currency pairs. An example of a currency pair is Euro USD. Usually currencies are traded in pairs. We're going to expand more on that. A currency pair, as an example, Euro USD becomes something like a product, very similar to the way you're going to have a phone having a certain price. Euro USD as an asset becomes like a product. And so we have commodities like crude oil, metals like gold, silver, platinum. We've got shares like the shares of Apple, IBM, and the likes. And then we've got cryptos as well. Now, one thing that's common to all of these various assets is the fact that they all will have a price within like the global financial markets, and that's usually constant price. And those prices could fluctuate. That is, those prices could go up or down as a function of demand and supply. So you could have a currency pair Euro USD at a certain price, and then, a function of demand and supply, technical behavior, different things that we will explain in detail later on. You could find that price either rises or falls, So the same thing with commodities, the same thing with metals, shares, cryptos, and the likes. Now, it is important to know that it is in the changing prices of these different assets that we as traders can hope to make profit. So that's a very critical thing to note. So the understanding of the behavior of these different products or assets or instruments will be what allows us really to be able to make money, and of course how we manage our own capital. All right, so you can see here that various factors cause prices to change. Traders follow these to determine the future direction of price and place trades in line. So these are the asset ranges. When you say you're trading FX, these are the things that you're going to be trading. You're going to be trading currencies, commodities, metals, shares, and the likes. So let's look at Forex pairs as tradable assets. As I mentioned earlier, you can think about a Forex pair as a product, very similar to a product off of a shelf in a grocery store, but we'll be looking into it in more detail. So we already know, from basic understanding of Forex, outside of trading it within an online platform or trading it off of a spot, off of the spot markets as we are trading it now, that demand and supply causes a change of price. All right, so let's take a closer look at a Forex pair. So usually when you have a Forex pair, you're going to have two currencies. The first is what we call a base currency, while the second, involved in the transaction, is called a quote or counter currency. So we can see here that two currencies are involved in every transaction. Those currencies will be represented with three-letter representations. So as an example, this currency is Euro USD. Euro EUR representing the euro, which obviously is the currency of the European zone, the Eurozone, whilst the USD obviously is the United States dollar, which is the currency of the US. All right. So in every Forex pair, you're going to have two currencies. Two currencies make up a Forex pair or make up the entire asset. So in order to have the asset class called Euro USD, as a single entity of a product, you have within that entity constituent two different individual currencies. Now let's take a look at what a forex quote looks like. So we can have, as an example, Euro USD as an asset. You note that the fact that the entirety of the asset is in white makes it like a block as an asset being priced at 1.32450. The meaning of this is that this asset, Euro USD, its current price is 1.32450. Let's talk a little bit about why it's Euro USD as an example, not USD Euro, because this is really important. The fact is, internationally, there is a consensus as to the representation of every quote. Okay, and once that concession is made, it's fixed. There's no changing it. You cannot use them interchangeably. All right, so you can't say USD Euro. That doesn't work. It has to be Euro USD. All right. So this is an example of a forex quote. There are many currencies, as you would find out later, representing different crosses of currencies of one country or the other, literally as many as the possible combinations of currencies of what we have. Now, let us look at what this actually means. What is the meaning of Euro USD as an asset class equals to 1.32450? What it means is that for every 1 euro, you will have a currency. You will be able to exchange it currently based on current price at 1.32450 USD. So every 1 euro will be exchanged for 1.32450 USD. That's what it means. Now, what's the object of trading? What are we trying to do when we trade? Understanding that you've got these financial assets, what really are we trying to do? The object of trading is to buy the base currency, okay, using the quote currency, and this is done simultaneously within the market. It's not something that you really have to do. I'm going to explain it in a bit more detail. Now, next, you can hold the base currency for a time. Okay, so after buying it, exchange, you hold it there's a holding time. So allow the price to rise based on demand and supply. Sell it back once the price rises. So you buy, you hold, allowing some time to go, then sell back, after a price change. That's the general object of trading. However, it's important to note that you can also buy the quote currency using the base currency. That's important. So that's a reverse of this example. And of course, we will explain this in a bit more detail. But just suffice to understand that the object of trading is to find an opportunity to buy or consequently to sell. We'll explain the difference between these types of orders whilst waiting for a time for price to change. Remember, the opportunity in profiting will only exist when there actually becomes a change in price. If you buy an asset and sell it at the same price, then your net gain becomes zero. So you have to actually wait for demand and supply to make an effect on that particular product. Then you can now hope to have a margin which becomes your profit. And of course, we'll explain this in more detail. All right. Let's look at other types in Forex. Now, basically, there are two other types in Forex. All right. The first is the buy order, which is shown here, which actually means buying the base currency using the quote currency, as the example of the instance that we gave in the previous slide. Buying the base currency using the quote currency. That's the first order type in Forex. Now, the second order type in Forex is the sell order, which means you're actually in the flip side buying the quote currency using the base currency. All right, so the first is when you click on buy, you actually buy the base currency. As an example, if you clicked on the buy of a Forex pair Euro USD as an example, what that would mean is that you're buying the euro, okay, using, okay, the USD. If you clicked on a sell as an example, the flip of that is going to happen, which would mean that you will be buying the USD using the euro. So I hope you understand that. We will explain that in a bit more detail as we proceed. So let's look at what asset of value exists for buy or sell orders. Now, this will bring home the understanding of buy and sell. What is the asset of value that exists when you're buying or selling? So again, we're taking the example of the Euro USD. When you buy, in this example, as we explained, you're going to essentially be buying the base currency using the quote currency, which means you're buying the euro using the USD. Now, the asset of value in this case is the base currency because it's a buy order. And because, the base currency in this example is euro. So the asset of value is the base currency because we expect it to rise relative to the quote currency. So when we're buying in this example, our asset of value is the euro. Okay, because it's the base currency, we expect it to rise. We anticipate a rise of the euro relative to the USD. What happens when we sell though? When we sell, remember we explained that essentially we are buying the quote currency. In this example, in the sell example, we're actually buying the USD using the base currency, which is the euro. If we sell, we're actually buying. When we sell, we're actually buying the USD, which is the quote currency, using the euro, which is the base currency. So it's exactly the opposite when we buy. So when we sell, our asset of value is the quote currency, which we expect to rise relative to the base currency. So buy and sell orders are actually opposite orders. When you buy, you're anticipating the rise of the base currency relative to the quote currency. Okay? And when you sell, you're anticipating the rise of the quote currency relative to the base currency. So let's look at this. So if you buy, you will profit when the price goes up. That's what it means. However, if you sell, you will profit when the price goes down. The meaning of that is if you buy, as an example, if you buy Euro USD at price, say 1.1 whatever, and the price goes to 1.200 as an example, you would have made a profit because the Euro USD as an entity, as a price, is rising. But if you sell, you will only profit when the price of Euro USD falls. So one of the cool things about Forex is that you can actually make money on the buy or on the sell side. Let's take an example, a practical example of what it looks like when you're making profit in rising prices. So let us give an example. Let us say you buy $1,000 at the current exchange rate of a dollar equals 168 naira. Now, if you're buying $1,000, it will cost you 168,000 naira because the current exchange rate is 168. Let's say after 1 month, remember the idea we said, the idea of trading, which is you buy or and then you hold for a while, allow for demand and supply. I'm not saying that you need a month to make money. It's just, this is just for analogy purposes. So let's say after a month, you see the rise of the exchange rate. The exchange rate rises from 168 to 220, and then you sold that $1,000. You know what? You will be getting a naira equivalent of $220,000. That's what you're going to be getting. So on the first part, you buy with $1,000 at 168 exchange rate, going to cost you 168,000. After a month, the exchange rate rises to 220. Okay, and then you sold it. Now you're going to get $220,000. Obviously, you've made a profit, which is the differential between what you now have, okay, when you exchanged it and what you bought it at, which actually means the difference is 220,000 minus 168 that it initially cost you, which obviously gives you a profit of 52,000 in this example. So let's look at an example of profit in falling prices. So let's say you sold $1,000 at the current exchange rate. All right. So you had $1,000 and then you sold it and then you got 225,000 now in Naira. When you sell, and a month later, as an example, you get 100. The exchange rate falls from 225 to 198. Then you go back to the market. Now you had 225,000. You go back to the market seeking to buy $1,000 in order to get your original $1,000 back. At the current exchange rate of 198, what that's going to cost you is 198,000 Naira. Now, in this example, you would have made a profit because what you originally sold your $1,000 for was more Naira. In this example, 225,000 Naira. And now what you're buying, because the exchange rate has fallen, back the $1,000 for is less Naira. So you're able to make a markup, which is 27,000, which represents the difference between the 225,000 and the 198. So let's take this home a little bit. Okay. And we will use this example to further drive home the meaning of the asset of value, because this is very important. So let's look at the trader's action here. Let's say the trader purchases 10,000 euros at the euros USD exchange rate of 1.500. That is to say, the Euro USD exchange of 1.500. Remember, when you're trading, essentially, and you click on buy, you're buying the base currency with the quote currency. Now, the quote currency in this example gets to be the USD. All right, and if we went by that exchange, in exchange for the 10,000 euros, you'd actually have to have spent 11,500. Are you following? 11,500 USD. Now, the asset of value in this example, okay, will be the euro because the asset is held while waiting. So, which do you hold while waiting? You purchase the 10,000 euros. That's what you have, okay, in exchange of this current exchange rate. All right. Now, let's say 2 weeks later, you exchange your 10,000 euros back to USD at the exchange rate, the new exchange rate of 1.2400. What are you going to get? You're going to get 12,400 USD, okay, and you still get your 10,000 original. I'm sorry, you're going to get your 12,400 USD, which means that you have made $900 more than the original amount that you bought it. So you earn a profit of $900. This should be $900. You earn a profit of $900 on that transaction. All right. So this is an example of making money. So when you buy the asset of value, this is very important. What you anticipate to rise is the base currency. In this example, your asset of value is the euro. Let's look at the example of selling. So in this example, let's say you purchase $11,800 at the Euro USD exchange rate of 1.1800. So you purchased 11,800. Okay, it costs you 10,000 euros, but what you have in your waiting period, okay, is the USD, which is 11,800. So 2 weeks later, you exchange your 10,000 euros back into USD at the current exchange rate of 1.3, which now gives you a new sum, which is what you still get, which gives you 11,300. Now the differential between these two gets to be 500, and you actually 600, I beg your pardon, this should be 600, and you earn a profit of 600. So what this means is that as you exchange the dollar, okay, you are actually able to get 600. The asset of value in this example is the dollar because it's the one held when time changes. So this is an example of making money whilst the price is falling. So let's quickly go to the quiz. Given the Forex quote of Euro USD equals to 1.0456, which of the following is a false statement? Number one, A, USD is the base, Euro is the quote currency. B, 1.0456 is the current price of the pair. C, Euro is the base and USD is the quote currency. D, 1 euro is equivalent to 1.0456 USD. That's the first question. Remember, you can always go to the quiz section of your portal and answer this question, and we will you'll be able to submit your answers and actually find out which is the true answer to this. All right. Now, moving on to second question. For the same quote of Euro USD at 1.0456, which of the following is a true statement? A, if you click sell, you make money only when the price rises. B, if you click buy, you make money only when the price falls. C, if you click sell, you lose money when the price falls. And D, if you click buy, you make money when the price rises. So you can ask this question again on your portal. Now, you can follow this link to ask questions about what you learned, bit.ly/Swavely chat. Always state the course and the model. And this is the end of class 1 module 2. See you in the next class.